Okay, hello. My name is Michael Burton. This is Meal Prep Monday, income strategies, ways to generate income. So, we're in this session. We're going to discuss loans and debts. This is a pretty long episode, so we'll probably break it up into two. Talk about loans, talk about debts. But instead of dragging this out for a whole 30, 40 minutes, I may just break it up. So, once I get to a particular area and I feel that we're going to fatigue, I'll break it up and then we'll pick it up on the next episode. So we're going to talk about types of debt first, okay? So you have your good and your bad debt. And all debt isn't good and all debt isn't bad. So let's talk about good debt. All right, so this is possible for the value to go up over time. Investment loans, home loans, business loans, and educational loans. So those are good debt. Bad debt, likely for the value to go down. Credit cards, personal loans, which usually have a high interest rate, payday loans, which have a higher interest rate, and car loans, which the interest rates vary based on your credit. So good debt, loans used to purchase items that appreciate in value. Loans used to create revenue streams. Loans used to buy assets. So typical examples, your home mortgages, investment loans for high HRI, business loans, educational loans. So bad debt, loans used to purchase items that depreciate up in value. Loans used to purchase items that don't improve one's financial situation. Typical examples include credit cards, personal loans, payday loans, and car loans, what we just discussed. So you have gray areas. Good debt can become bad debt, and bad debt can become good debt. Mortgages on mortgage on property that lose value. Student loans when you drop out of school. Student loans when your earning potential is not what you expected. Investment loans for stock that tanks. Okay, so this is the gray area where bad debt can become good debt. Using credit cards to buy clothes that help you land a great job. Using a credit card to buy something that appreciates in value. When you pay your credit card balances in full every month. And when you get a car loan for the minimum vehicle you need to earn income. So the fundamentals of loans. Components of a loan payment. So you have the amount you borrow, which is your principal. You have how long between payments, monthly, quarterly, or annually. You have your total repayment period, your term, and the amount you charge to borrow, which is your interest. So those are the four components. So let's talk about the fundamentals of a loan. You have your principal balance, the total amount you owe, the interest, the amount the lender charges you to borrow the money, the interest rate, percentage of which interest is calculated, determined by the level of risk the lender thinks you pose, payment interval, how often you must make the payment, and the term, the amount of time you have to repay the loan. Compounding interest. We talk about compounding interest. Albert Einstein, compounding interest. Those who understand, earn it. Those who don't, pay it. Essentially, interest paid on interest. When a debt compounds, any unpaid interest is added to the principal. Then you pay interest not only on the principal, but on the unpaid interest too. Amortization introduction. Let's talk about amortization. Every payment contains a principal payment and an interest payment. The portion that goes to interest is higher earlier in the long term. That procedure is called amortization. So making extra payments above the fixed payment amount reduces the principal faster in the long term. So I guess an example of this, buying a house, 30-year mortgage, your mortgage payment is $1,000. Usually $800 of that goes to interest, $200 of that goes to the principal. But if you pay over that $1,000, you put it towards the principal, then your payments and the months are going to decrease over time. And you can also do that on your handy dandy financial calculator as well. Risk of debt. Different kinds of debt pose different kinds of risks. So you have your debt to friends and family, and usually when you're dealing with friends and family, you're not gonna get that money back. Home loans, auto loans, student loans, credit cards, payday loans. So what is debt? One party borrows money from another party. So you got to give and a taker. Promise to pay the principal plus the interest later. Two kinds of debt. You have your secured debt tied to an asset and unsecured debt not tied to an asset. We also discussed this in one of our Meal Prep Monday shows as well. So if you haven't seen it, go back and check out those podcasts as well. Not all debt is problematic, but runaway debt can cause dramatic life problems. Debt risks, borrowing from friends and family, hurt feelings, resentment. Again, I consider it as a gift. If you ask for a loan for $60, I'm gonna go in with the assumption I'm not gonna get it back. Verbal arguments, and this really does happen. Decreased or uncomfortable contact, especially during Thanksgiving and Christmas. Lawsuits, physical altercations. It does happen. Tips to mitigate risk. Don't do it. Consider it as a gift. Like I said, find other ways to assist. Debt risk for home loans. ARMs, the adjustable rate mortgages. Those that was very prevalent for 2008, 2009 mortgage crisis when you had an ARM of 2% 1 month and the next month it shot up to 18%. So those are very risky. Monthly payments greater than 30% of the salary. Penalties, foreclosures. Tips to mitigate those risks. Budget before buying. Make a higher down payment. Choose short-term loans. Prepay loan mortgage ahead of schedule. All right, so debt risk for auto loans. Falling behind on payments. Repossessions. High interest rates. Vehicle loss value. Tips to mitigate risk for auto loans. Purchase with cash. Budget before buying. Buy used versus new. Choose short-term loan limits. Student loan debt risks. Withheld transcripts. We know how that is. Lawsuit, wage garnishments, long-term credit problems. Tip to mitigate risk for student loans payments. So before we do that, if you're doing bankruptcy, you cannot discharge student loans, alimony, child support. You can't. Not with bankruptcies. So ways to mitigate risk: calculate your return on investments, pursue scholarships, grants, and financial aid, take a part-time job, and know the long terms. The long terms. Credit card risk. All right. High interest rates, collections, bad credit scores, lawsuits. Tips to mitigate credit card risk. Don't use the credit cards. Pay balances in full every month. Nothing should be in the red. Restrict card use. Always make payments on time. Payday loans, the worst. Astronomical interest rate, as much as 350%. Strong arm collection tactics to mitigate these risks. Don't get a payday loan. Seek help from an alternative source, family, friends. Talk with a credit counseling agency. Talk with an attorney, which is still going to cost you money. Assess your debt risk. Take your total debt payments each month. Include all payments reported to credit bureaus. Don't include other living expenses, groceries, utilities. Is the total less than 30%, 36% of your income? And use that, actually, it's actually a second end of your housing ratio, less than 36%. The front end is 28, back end is 36. If so, your debt risk is fairly low. If not, you may be at risk for financial trouble. Loan qualification. So 6 processes or 6 steps in the loan qualification program process, you guys. So the first one, check your own credit score first. Get a pre-qualified loan. Shop around for the best lender. Comparing the offers you get from those lenders with other options for credit. Reading the fine print. And the last step is final loan approval. So what is a loan? Made by financial institutions, may range anywhere from 1,000 to 500,000 or more. When you apply for a loan, you must negotiate. Principal balance, how much you want to borrow. Term, how many months you have to repay it. The interest rate, the amount you pay above the principal. Secured loans require collateral. Unsecured loans require no collateral, but usually there's a higher interest rate for the unsecured. So again, in the loan process, step one, checking your credit score. Different kinds of debt pose different risks. Debt to family, debt to and friends, home loans, auto loans, student loans, credit cards, and payday loans. Okay. Getting pre-qualified. Fill out the pre-qualification form. They want to know your income, occupation, existing debt. Lending institution does a soft credit check. So this doesn't hurt your credit. It's a soft check. The lender approves or denies you. If approved, you decide whether to accept or decline the offer. You can repeat this step with multiple lenders to compare offers. Shopping around for the best lender. Pre-qualify with several lenders and compare terms. Compare each lender offer according to the loan terms, interest rates, payment amount, any hidden clauses in the fine print. Comparing loans with other options. So explore credit options with options other than taking out a loan. Balance transfer credit cards with 0% interest for the first year. Be sure you can pay off the balance within the promo period. Secured loans may offer lower interest rates. And again, unsecured loans usually have a higher interest rate because it's based on full faith. And maybe potentially get a cosigner. Cosigner takes on equal responsibility for the loan. So be very careful about this option. Read the fine print. Reading the loan agreement carefully is worth the effort. Look for red flags that might signal predatory lending practices. Some contract terms may cause trouble, prepayment penalties, interest rate not factored in clearly. Some contract terms are favorable though. Late payment forgiveness, ability to choose your payment dates, a direct payment to your creditors, reporting good payment credit history to the credit bureaus. Okay, and so the final loan approval. You have chosen a lender and accepted an offer. You will be asked to provide additional documentation such as your official ID, which is a driver license, passport, military ID, document that verifies your address, which is your utility bills, lease agreement, things like that, documentation of income, W-2, pay stubs, bank statements, tax returns. The lender runs hard credit checks, which hurts your credit. The funds are then transferred into your account. All right, so we talked about the 5 C's a few episodes ago when we first started doing the Meal Prep Monday. So the 5 C's from the lender, and they take these into effect. Your character, all right, your credit record and payment history, the capacity, the ability to pay off the loan, the capital, the amount you have upfront for a down payment, collateral, the assets you have to secure the loan, and the conditions, the term of the loan. So the final tips on this. Have a budget in place that factors in the loan amount, a loan payment. Aim for a loan amount you know you can afford. Always carefully evaluate your loan options. Always read the fine print of any offer. And when used properly, loans can be helpful it can be a helpful financial tool. All right, so let's keep going. All right, so how to pay off the debt. Recommended debt payoff methods. List your debts in details. Contact debtors. Pay debts with highest interest rates first. Root causes. So you can RCA, root cause analysis of out of control debts. Spending money on lifestyle or statuses. Looking good has the highest investment cost with the lowest return. My man Tijuana Jackson say that. So there's no ROI for trying to look good. All right. Spending money on lifestyle or status. Not being aware of income versus expenses. Not understanding long terms. Having to deal with the loss or medical expenses, gambling, reduced income or unemployment. So that's the earned income. If you're in the earned income bracket and you stop working, where your money going to come from if you don't have all the different streams of income? So you want to be mindful of that. The earned income, that's when you hedge investments. So you have your paying off debt strategies, debt avalanche. All right. So the debt can snowball. So when the debt avalanche, usually it hit the percentage rates, the dollar amount, all that factors into it. So list debt in order of rate by your interest rates. Make the minimum payment on all accounts. Pay any extra towards the one with the highest interest rates first. Continue until all debts are paid off. So that's the debt avalanche, and it goes downhill. So debt snowball is going to go kind of sideways. So list all debt in order by balance. Make the minimal payment on all amounts, on all accounts. Pay any extra towards the one with the smallest balance. Continue until all debts are paid. So the snowball effect kind of goes sideways. The avalanche is going downhill. But those are two strategies that can help you. All right, so let's talk about the pros and cons of avalanche, which is the preferred method, and the snowball, which is the kind of sideways going down. So the pros with the debt for the preferred method, the avalanche, you pay less in interest, and it gets you out of debt faster. You see high interest rates vanished. Some of the cons are visible progress takes time. So it's going to take time for you to see the progress of those. So some of the pros of the debt snowball provides motivation. You see the progress quicker. Some of the cons, you pay more in the long run, so you're still paying the interest rate. The process takes longer and you pay a higher interest rate. Other methods of debt payoff: balance transfers, personal loans, debt consolidation, debt settlement, bankruptcy. And again, bankruptcy, you can't charge off student loans, alimony, child support. Remember to weigh the benefits against the risks. So risk rewards. Create your own debt payoff plan. And we have those on the Meal Prep Monday website. So when you sign up for Meal Prep Monday, you get the budget sheets. We have workflow analysis, budget analysis, payoff calculators. We do have those embedded on the site. List all your debts. Choose your strategy. Avalanche, which is the recommended, versus the snowball. Select the debt you want to pay off first. Calculate how much extra you can pay. Calculate the number of payments left on the first debt, and continue working with the plan until all debts are paid. Credit card 101, credit cards. And we talked about credit cards a lot in several of these sessions, so they kind of overlap. So you see the importance of credit cards and paying them off, the cons and the pros of credit cards. So credit cards, financial instruments. Credit cards are financial instruments that let you borrow money for purchases. They're loans. Credit cards are loans with interest rates. Some of the unique benefits is that may offer benefits like theft protection, travel assistance, rental car insurance, discounts, and rewards. But stay in control. To work credit cards to your advantage, you have to have a written budget, emergency money set aside, and control spending. Pay off in full. When you use a card, pay it off in full every month. And most importantly, read the terms. Read the terms carefully, understand the terms, conditions, and the privacy policy. So some of the unique features of credit cards: greater protection if lost or stolen, safer than carrying cash, discount or rewards program, emergency assistance, rental car insurance, discounts on travel, groceries, gas, cash back on purchases. Can be used as a tool to improve your credit rating as well. Best ways to manage a credit card. Be the credit card company's worst customer. All right. Make purchases and pay off balances in full on time each month. Ensure that it works to your advantage. Again, have the emergency money set aside, control your spending, and have a strong working budget. Get a credit card that offers special bonuses. How people get into credit card trouble. So they make only the minimum payment. They carry balances month to month. Don't understand the terms and conditions. Forget when the promotional interest rate will expire. And don't understand the concept of compounding interest. Again, compound interest. Those that understands it, earns it. Those who don't, pay it. Automobile finance. Let's talk about loan and lease options. So your purchase decisions when purchasing a vehicle, loan terms, interest rates, vehicle cost, your credit score, your debt to income ratio, insurance requirements. Auto buying process. Decide on your desired loan terms, consider interest rates, gain pre-approval, buy your car and finalize your loan. What car lenders consider your credit scores, debt to income ratio, available capital. Pitfalls of winding up upside down. The amount you owe is greater than the car's value, which is bad debt. You have negative equity in the vehicle, which is bad debt. What can you do? Continue making the payments as scheduled. Eat the negative equity. Renegotiate the loan terms. Avoid becoming upside down by taking out a short-term loan. All right? Beware of the repo man. What if you can't make the loan payments? The lender contacts the repossession or repo firm. Repo company comes and takes the car back. You lose the money you paid on the loan payments. You lose the down payment you made. You lose the car. Your credit history is severely damaged. Insurance requirements. Minimum insurance is mandated by the state. Lenders usually require full coverage. Full coverage comprises of 3 types of insurance: liability, collision, comprehensive. Shop around for the best insurance deals. So leasing, not the best choice for most people. Good for small business owners or unique circumstances. You build no equity in the vehicle. Essentially a long-term rental. You return the car at the end of the lease term. Usually pay options to finance and purchase the car at the end of the lease. All right, so qualifying for a home loan. So we're almost at the end of this. Mortgage loan options, FHA loans, good for first-time buyers, backed by the federal government, requires a relatively low credit score to qualify. Credit score can be 580 plus. You can get an interest rate as low as 3.5%. FHA loans do have restrictions. No foreclosure in the past 3 years. Maximum loan amount vary by area. 2 important ratios when applying for a mortgage, and we talked about these. Your housing ratios. You got your front end and your back end. Housing expense to income ratio. So that has to be up under 28%. And debt to income ratio. So your obligated debt payments compared to your gross income. So that's your debt to income. And your housing is just your housing cost divided by your gross payment, up on the 28%. And the last one is 36%. So housing expense income to ratio. All right. Total monthly housing cost divided by your monthly, so your gross. All right. So let's do this. And we did this one time before. All right. So let's say I make $100,000 a year. That's annual though. We need monthly. So you're going to divide 100,000 divided by 12. So now my monthly income is 8,333. My monthly gross income So my total monthly housing cost is 1,500. All right, so we're gonna divide 1,500 by 8333. So 1,500 divided by 8333, and that came out to 18%. So I qualify on the front end. All right. So on the front end, I'm 18%. I gotta be lower than 28%. All right. So housing expenses include your PITI, your principal, interest, taxes, insurance, and association dues, HOA fees. Housing expenses do not include maintenance, repairs, or deductibles. The lower the number, the better your ratio. All right. So now let's talk about your debt to income ratio. So this got to be less than 36%. So that's still going to include your PITI, your car payments, credit card payments, installment payments, student loans, consumer loans, okay? So we're going to say that came up to, let's say 4,500. It came up to 4,500. So we had that 4,500 plus 1,500 was our PITI. So that's $6,000. So we got to do the $6,000 divided by the 83. And that came out to 72. So your back end is 72. You will not qualify. So just some FYI. So you have to pay down all those loans and debt to get that below 36%. Okay? So the process, so checking your credit scores with those three bureaus we talked about, TransUnion, Equifax, and Experian. And they also have your FICO and Vantage score. So checking your credit score, FHA may allow a credit score of 500 to 790. I mean, if your score is 500 to 579, you will pay a 10% down payment. If your score is 580 plus, you'll receive a 3.5% down payment rate. Big difference, you guys. So make sure you have that in order and take care of that before you look for a house. Other lenders require higher credit scores, 620 and up. If your score is low, request a free credit report and take the steps to improve those credit. Improve your credit. Check for errors and have them removed. Avoid utilizing full credit limits. Bring all payments up to date. Getting pre-approved for a mortgage. Okay, pre-approval loan requires proof of income, which is your pay stubs, W-2s. Lender may call your employer to verify. Proof of assets, bank statements, investment accounts. Decent credit score. Buyers with 760 get the best interest rate, 760 plus. Verification of employment. Lenders will call your employer. Other documentation include your driver license, Social Security card, and signature. Shop around for the best lender. Pre-qualify with several lenders and compare interest rates. Credit checks performed within the same 45-day window should only count as one against your credit score. Mortgage lenders are required to give you a loan estimate within 3 days of your application. Read the estimate carefully to understand all the terms and stipulations. Comparing loan options. So the FHA, easy to obtain, government-backed, low down payment. So remember that DITI, 31 to 43%. That's your debt to income ratio. Conventional loans, typical down payment is 20%. Credit score is 620 plus, and low DITI. VA loans. For veterans, active duty members, reservists, and families, credit score is 620 plus, DITI of 41%. All right, let me get comfortable here. Home ready, home possible loans. Fannie Mae, Freddie Mac, 620 plus credit score, but lack of credit history, okay. Outside income may be included. All right, read the fine print. Reading the loan agreement carefully is worth the effort. Look for red flag that may signal predatory lending practices. Some contract terms may cause trouble. Prepayment penalties, interest rate not factored in clearly. Some contract loans are favorable. Late payment forgiveness, ability to choose payment dates, direct payment to your creditors, reporting a good credit history to the credit bureaus. Final loan approval. All right, you have chosen a lender and accepted the offer. Additional documentation may be needed. Lender runs hard credit check, which is going to affect your credit history. The funds are then transferred to your account. Okay? Remember those 5 C's that they're going to evaluate for: your character, capacity, capital, collateral, and conditions. Final tips. Be careful who you borrow from. Choose a reputable lender with no predatory practices. Be sure you can pay back the loan. Make the payment fit into your budget and long-term plans. Take plenty of time to make the decision. And so this is Michael Burton, Meal Prep Monday, 10 Income Strategies. This is Loan and Debt. Check me out. Facebook, Instagram, Twitter, YouTube, Meal Prep Monday, mealprepmonday.com, www.podbean.com/Meal Prep Monday. Thank you and enjoy.